So you probably have a financial advisor, and I bet he always says that your money is managed to the highest standard. But really, is it? And more importantly, how do you know it is? I mean, do you really think your financial advisor will ever tell you that he is not doing a good job and you should probably shop around somewhere else? Hi, my name is Darius Muica, a senior investment advisor with Nur Private Wealth. If you are new to my channel, I focus on helping clients build wealth in the most tax-efficient way possible. So if that is something you are interested in, make sure to subscribe so you don't miss any of my future videos. And if you like this video and you found it helpful, don't forget to hit the like button. It really helps with the YouTube algorithm. In today's video, I will be talking about why you should not go another day without getting a second opinion on your finances. Did you ever get a mortgage renewal letter from your bank? How easy was it just to sign it and send it back, you know? Problem solved and you can move on with your life. A couple of years ago, I got a renewal letter from my bank, and just before signing it, I thought, hey, why don't I call a few other banks and get a quote? Sure enough, after a few calls, my mortgage rate dropped by 0.3%. I'll be honest, I did not end up switching, but sure enough, my bank matched the rate once I presented them with the other offer. When talking about investments, some people tend to think it is a set and forget kind of thing. But in reality, the market changes just like the weather does. And you would not be wearing your winter jacket in the summer now, would you? Your financial situation is constantly changing, and the scientific study done by Cyrano shows that investors with a financial advisor were found to accumulate 3.9 times more assets after 15 years. When investing, there are 4 important points to take into account: the financial plan, taxes, fees, and of course, investments. Let's start with the financial plan. Many people might already have one in place, but it hasn't been reviewed in years. This can be a very costly mistake, and here's why. Let's take John and Jane Smith, both retired, 60 years old, and living in Toronto. Together they have $1 million in their RSPs, which they don't need since their pension income and cash investments covered their lifestyle expenses. Having not reviewed their plan with their financial advisor, their investments in RSPs continue growing over the years. By the time they've reached 72, their RSP investment account grew to $1.9 million. At this point, the account gets converted to a REIF account, and now they have to take 5.28% as REIF minimum from their investments. This increases their taxable income by $103,000, and their taxes jump from $11,000 to $45,000. Had they reviewed their financial plan at the age of 60, this issue would have been easily spotted, and the plan to melt down their RSPs would have been put in place. This way, their tax bill over the years will be lower, they will avoid jumping to a higher marginal tax bracket and any old age security clawbacks. They will save 25% in taxes after the age of 72 and will have around a third of their money in non-registered investments, which can easily be accessed without worrying too much about the taxes. And this is a great example why you would want a second pair of eyes reviewing your financial plan. So do yourself a favor and avoid that "I wish I knew about this 10 years ago." Another important point is the fees. Let's assume that John and Jane have 3 financial advisors as follows. They have $250K with firm A paying 1.5%, $550K with firm B paying 1.25%, and $200K with firm C paying 1.6%. Getting a second opinion, they would find out that the account can easily be consolidated with any of the firms, and they would benefit not only from better service, as it is a larger account now, but also their fees would drop to 1%, helping them save $3,825 a year. The last point, and the hardest to get a second opinion on, would be your investments. Taxes, fees, that's something very straightforward. I mean, you save $1 in taxes, that's a guaranteed return in your pockets. But when it comes to your investments, it gets much more subjective. Let's say in 2019, your portfolio returned 13%. Most people would be very happy with that return, but how do you know if it is actually good? Let's say your portfolio has 50% Canadian and 50% US stocks. In 2019, the TSX did 19.1%, while the S&P 500 did 30.4%. The benchmark return for your portfolio is 24.75. all of a sudden, your 13% does not sound so good anymore. Getting a second pair of eyes providing you with a benchmark on your investments could help you understand how your portfolio is doing, your asset allocation, risk and strategies, if any. That's it for today's video. I hope you found it valuable, and if you haven't done that already, make sure to hit the like button. And if you want to see more videos like this one, don't forget to subscribe to my channel so you don't miss out on anything important. Also, don't forget to hit the notification bell so YouTube notifies you when a new video is uploaded. If you have any questions or you want more information, leave a comment below. Thank you very much for watching, and I will see you next time.